inventories and the kind. To quickly talk about what is the requirement under CARO 2020 and what we believe are the points you should take back at the end of this discussion. The first requirement that one sees for CARO for property, plant and equipment and intangible assets is that proper records and full particulars of PPE and intangible assets need to be kept. Now, this is not very different from what you would have seen in the erstwhile CARO. What I would like to highlight here is that the term proper records is not defined in the guidance note. Generally, what is expected is the description of the asset, the location of the asset, the quantity, the date when it's put to use, if there is revaluation or impairment. Interestingly, the guidance note acknowledges that for companies that have been in existence for a long period, for a practical situation where, say, a company purchases 50 laptops in a single invoice, there could be practical issues around how do you allocate the cost to each of these items. What do you do if you do not know the date when an item is disposed of or sold? The guidance note does permit reasonable assumptions to be made in setting up of your fixed asset register. As an auditor, you would normally go and audit the fixed asset register. If you are management, please keep the fixed asset register handy and please look at whether some of these items that we just spoke of are covered in your FAR. The other item that CARO 2020 requires is the reasonableness of the frequency of verification of these assets and the accounting for discrepancies, if any. This clause requires management to physically verify inventories at a reasonable interval. The auditor needs to comment on whether the verification has happened during the year, whether all assets are verified at least once in 3 years, if not annually, and finally, if the verification results into discrepancies between the books and the physical assets that are there, whether those discrepancies have been dealt with appropriately. The guidance note once again does provide some bit of practical implementation support. It says you could have industries where it is not physically possible to check an asset. If you have a continuous process plant, which is housed within a larger plant, you could go back and fall back on indirect evidence of testing. This indirect evidence of testing could be something like, if my plant or an oil refinery, for example, is functioning at normal levels of efficiency, that is sufficient evidence to state that the smaller component or the asset is working properly. Because if that was impaired, if that did not exist, the business operations would have shown an exception. So key takeaway from the point of view of verification is reasonable intervals. Verification should have happened during the year. If on account of COVID, the verification of assets has not been possible in the current year, the auditor may end up highlighting that during the year the assets may not have been verified, but once in 3 years the management ensures all assets are verified. So that is more about reasonableness and frequency of verification of fixed assets. The third item, and this is a new item introduced in CARO 2020, is that the auditor is now required to comment on whether the title deeds of all the immovable properties held by the company are in the company's name. Friends, this is a very interesting requirement for two reasons. First, this applies only to immovable property that is held as PP&E. So if you have a real estate company for whom immovable property is inventory, reporting under this clause does not trigger. Also importantly, the guidance note very clearly states that, or CARO 2020 very clearly states that this does not apply to assets that are leased. So if the company is a lessee and has taken an immovable property on lease, then the reporting under this clause is not applicable. And this is an example where I will show you why the devil is in the detail. If I move on, the other requirements with respect to property, plant and equipment is that if there is a revaluation of fixed assets or PP&E or intangible assets, the auditor needs to comment on whether a registered valuer has performed the valuation, and in cases where the change between the carrying value and the revalued amount is more than 10%, it could be an increase or it could be a decrease. This is something that the auditor needs to report on. And a very interesting point that comes out of this is that internal valuation specialists, it appears, are not acceptable when it comes to revaluation of PP&E. So take for example that you are a housing finance company, you have qualified valuers on your payroll because they need to assess the value of property that is considered as a collateral while giving a home loan. They are absolutely capable and competent to do a valuation of assets of the property, plant and equipment of the company as well. But the clause and the guidance note together seem to suggest that one would need an external valuer or registered valuer under the Companies Act to be actually able to do this. And the last clause which has now been introduced, and which is again a new clause, is that there needs to be a factual statement as to whether any proceeding has been initiated against the company under the Benami Property Transactions Act, and if adequate disclosures for the same have been made in the financial statements. So from the standpoint of property, plant and equipment and intangible assets, these are the 5 clauses that are relevant. Our takeaway from these 5 clauses, or the point where you need to be mindful of, is the devil is in the detail. The clause heading talks of property, plant and equipment, but if one goes to the guidance note, investment property, right of use asset, assets held for sale are also covered. So please keep in mind that providing the auditors with your fixed asset register alone may not be sufficient. You may expect to see the auditor come and question, what about assets held for sale? Once again, if you are an NBFC which has repossessed assets like property and has shown them as held for sale, you could expect the auditor to come and quiz you on some of these aspects that we just spoke of. And this is again a bit of an item that requires discussion with the audit teams upfront. Item number 3 on title deeds, as you see on the slide, says leased assets are excluded. But if one had to go through the guidance note and look at the audit procedures therein, one would actually end up seeing that the auditor says, or the guidance note states, although the auditor is not specifically required to test leased assets, there is no direct responsibility cast on the auditors with respect to leased assets. It is expected that the auditor will check if these lease agreements are executed in the company's name or not. And if there are exceptions, it is prudent to include this in the auditor's report. Now, this is a classic case of not having read the guidance note, and the auditor then coming in April, 2 weeks before the audit committee, and saying, by the way, I need to test these ROU agreements as well. So our suggestion here, our takeaway from this is, look at the fine print in the guidance note. If you identify items like these, which needs an upfront planning and a discussion with the auditors, the time to do it is now. Clauses around revaluation of assets, a greater level of challenge by the auditors. The auditor will now no longer take valuations at face value. In the current environment, they could very well go ahead and look at what is the competence of the valuer, who is the registered valuer, what is the methodology used, what is the technique used. But if you have a revaluation model for fixed assets, you should anyway be used to seeing this kind of test in the measurement related aspects. Finally, an interesting point to keep in mind is what happens if there is an immovable property not held on in the name of the company, or the title deed is not in the name of the company. Would it automatically be considered to be Benami property and therefore trigger reporting under clause 5? Our analysis is, if one had to read the guidance note, the answer is no. The guidance note only requires a very factual assessment or a statement. It says if a proceeding has been initiated, that is the only time you need to trigger a reporting requirement. So that's a bit of an interesting take from the items related to PP&E, inventories, and